Thank you, Stacy. I appreciate it. And welcome, everybody. Glad you could spend some time either this afternoon or this morning with us to learn about the Employee Retention Credit and Provider Relief Funds. My name is Jim Donovan. I'm a partner here at Eide Bailey, and I lead our ERC, or Employee Retention Credit team. When I'm not doing ERC, I also focus on the R&D tax credit, but ERC has consumed the last year and a half of my life. And there's a lot of fun things to share, and we look forward to doing so. Joining me today will be Tyler Bernier and Sean Delury, and I'll let them introduce themselves.
Thanks, Jim. Tyler Bernier. I'm a partner out of our Oklahoma City office, and like Jim, been consumed with these COVID programs for about the last year and a half, but in particular, the Provider Relief Fund. So, Jim and I got together and said, hey, there's a lot of new stuff that people still don't know on ERC. And I said, yeah, there's still a lot on PRF. And we both said, well, they're probably sick of hearing us. Maybe we should cut it down and do it together. And then we came up with the bright idea, we should probably include Sean, because then at least we have a new face and voice. So Sean, welcome. Pressure's on.
Thanks for including me. Sean Delury, Healthcare Consulting Senior Manager out of the Minneapolis office. I work with Jim on the Employer Retention Credit. I haven't been doing it maybe quite as long as Jim and as steady, but it's been a lot of fun. It's been great to work with the healthcare providers on this, and look forward to going through this presentation with you. So
awesome. Well, thank you, Tyler and Sean. And we'll hop into employee retention credits first, and save, Tyler has the fun stuff, right? So we'll let him go last. All right. So get the screen to shift here. Nope, too far. All right. So today we're going to talk about the ERC, some recent legislation that's happened around ERC. We'll talk about the basics. We'll talk about PPP and how that interplays with ERC. And then we'll talk about substantiation of the credit and some examples today. We can easily go have a 2-hour session on ERC, but that would be a lot of legal detail, a lot of tax law. And while I'm a geek and totally into that, it's probably more than what you guys need today. So we'll get you the basics so you know enough to be dangerous, right? And then you can reach out with additional questions. All right, so you're probably saying, gosh, Jim, why do I care about the employee retention credit? Well, first of all, it's a credit, right? It can put cash in your pocket. So the ERC came out as part of the CARES Act in March of 2020. It was expanded twice. First as part of the Consolidated Appropriations Act in December of 20, and then as part of the ARPA, or American Rescue Plan Act, in March of 21. So initially, we had a $5,000 credit per employee for 2020. In 2021, that's up to a $7,000 credit per employee per quarter. And I can already tell you that my slide is now out of date because it shows us having up to $28,000 per employee in credit in 2021. But we do have some recent legislation. So the infrastructure bill passed the Senate, back in August. It finally passed the House last Friday. So what does that mean, right? Well, I guess first of all, the president hasn't signed it yet, but we fully expect that he will. But in the infrastructure bill, it repeals the employee retention credit for Q4 of 2021. For the most part, we have a lot of people that aren't qualifying for the employee retention credit in Q4 or wouldn't qualify. So it's not a huge hit, but if you are one of those employers that would have qualified, it certainly takes dollars out of your pocket. Now, there's a possibility that Q4 will be reinstated in the reconciliation bill, but it's Congress, right? And who knows what's actually going to happen. It was repealed as part of the infrastructure bill as a pay for, right? So who knows what will happen, but just know it could come back, I guess. A lot of people have already planned on it because this bill was initially passed by the Senate in Q3, They didn't think it would be a big deal. Now it's going to be a legislative nightmare, administrative nightmare for the IRS. Now, if you're a recovery startup business, that credit is still available, but I don't expect that to apply to many in this group. All right, so let's talk about some basics here. And what I've done is I have a chart here that kind of outlines the credit for 20 and 21 because there are different rules. Now, technically, 2020 stands on its own. 2021, there's actually two sets of law. Q1 and Q2 were under the CAA, Q3 and Q4 under the ARPA. But for all intents and purposes, the rules are the same for Qs 1 through 3 right now. So for 2020, we have this March 13th through December 31st timeframe. It's up to a 50% credit rate, or it is a 50% credit rate on qualified wages of up to $10,000 per employee. Now you're saying, gosh, Jim, if I only paid somebody $8,000, what does that mean? Yeah, then it's still a 50% credit rate. It's, you know, a $4,000 credit for that employee, right? So just up to a $5,000 max. For 21, the credit rate is 70%. You still qualify up to $10,000 per employee, but instead of in 2020, it's like a 9-month period. In 21, it's each individual quarter stands on its own. So, you know, it could be a $7,000 credit per employee in Q1 if you continue to qualify in Q2 and Q3. So it's a more lucrative credit in 2021. It's also easier to qualify, as we'll get into a little bit later. There are different rules for an eligible small employer, and we'll get into that a little bit later as we dive deeper into some of these rules here. So you know, this kind of leads into, gosh, how do I qualify for the credit, right? If you're deemed to be an eligible employer, if in 2020 you had a greater than 50% decline in gross receipts in any calendar quarter in 2020 versus 2019. 2019 is always our base year. It's the last quote unquote normal year. So we're always comparing to 2019. And we'll go into a more detailed example in the next slide, but just wanted you to know that, you know, it's a fairly high hurdle to meet for 2020. In 21, that hurdle has changed. So if you have a greater than 20% decline in gross receipts in any calendar quarter in 21 versus that same calendar quarter in 2019, you can qualify for the credit. So for example, if you had a greater than 20% decline in Q1 of 21 versus Q1 of 2019, you would qualify for Q1 of 2021, sorry. There's also an alternate quarter provision in 2021 that's applicable. And basically it allows you to qualify for more than one quarter. Basically, if you qualify in Q1 of 21, you're also going to qualify in Q2. Each quarter stands on its own. There's just a couple of different ways to qualify. The gross receipts definition is fairly broad. For-profits, it's 448C, not-for-profits, it's 6,033. I think the key thing to know from that is it's a very broad and inclusive definition for both. The second way to qualify for the credit is a suspension of operations. And this is basically due to a government order that partially or fully shuts you down. And, you know, for many of you, you had a restriction on elective procedures, right? In late March through give or take May of 2020. That would be an example of a suspension of operations due to a government order. Again, we'll go into a little more detail in a future slide. Finally, I'll talk about government instrumentalities. In 2020, those are not qualified for the ERC. In 21, we have a little bit of an expansion of the definition. So, you know, for this group, if you are a government instrumentality, but your primary purpose is providing medical or hospital care, you can qualify for the ERC. So those are some of the highlights here. And again, we'll get into some details, especially around gross receipts and the suspension of operations here in the next slides. And with that, I'm going to hand it over to Sean to talk about gross receipts.
Thanks, Jim. So when you look at, as Jim said, there's two ways to look at it. There's the gross receipts and the government orders. So The gross receipts is often looked at as the easiest way to qualify, just because, like Jim said, it's a broad definition. We know what the gross receipts are for every quarter. So oftentimes we take a look at that first. And for 2020, it is 50% decline compared to the 2019 quarter. So that's what we need to look at, comparing 2020 to 2019 for each quarter. Down below, we have an example. And then as the next bullet point says, you remain eligible actually until you hit that 80%. You exceed 80% of your 2019 gross receipts. So that's kind of the good news, is you get some wiggle room there and you can qualify until you hit that 80%. So as you can see the example below there, we have the 2020 gross receipts and the 2019 gross receipts. We're at 90% in Q1. Q2, obviously, as we think back, like Jim said about COVID-19 and the elective procedures, maybe we took probably a likely hit in the gross in the revenues there. So you can see 5 million divided by 12, or 42%. So we're under the 50, so that makes us eligible. And then in Q3, you can see we're at 9 divided by 11. So we're over that 80%. So that'll be the last quarter then that we're eligible for the ERC for 2020. If we were under 50% for Q4, then we could become eligible. But since we're at 70% in this example, we're not eligible for Q4. So at the end of that example, we're eligible for Q2 and Q3 for 2020, based on that reduction of 50% compared to the 2019 quarter. So that's how the gross receipts test works. Like Jim said, it's very inclusive. You start with your revenues based on your tax return, if you're for profit or a nonprofit. We look at the quarters that you have for 2019 to 2020. And another thing to keep in mind as you're looking at this test is that the aggregation rules do apply. So if you follow, I don't know if you think back to ACA reporting rules or not, but you got to consider all the entities that are within the similar ownership structure. So a lot of healthcare entities might just be one healthcare organization, but you think about maybe the post-acute or senior living organizations, they might have an assisted living that they own, or some other ancillary entity that is under their umbrella. You'd want to consider the revenues for all of the entities then when looking at this test. A lot of times when we look back in 2020, we ran into this case with, if you think about clinics that are on this webinar, they might have had a surgery center that they either owned or had a substantial business relationship with, where a lot of the revenues were tied to the clinic for the surgery center or the hospital for the surgery center. Well, that under the aggregation rules would most likely pull that surgery center in with that clinic or hospital. So when we're looking at gross receipts, we want to take a look and consider those aggregation rules. You can go to the next slide. Oh, there we go. Thanks. So for 2021, like Jim said, there is good news in 2021. That gross receipts test is easier to meet as it's reduced from 50% to 20%. So that's very helpful, obviously, for organizations. And also, we're still comparing to 2019 and not to 2020. So that is also good news. We can compare to the higher revenue number in 2019. So that'll help a lot of entities in 2021 in terms of the retention credit. And as Jim mentioned, we get to use this alternative quarter for 2021. So if we look at the first quarter for 2021 compared to 2019, and you go, oh, we don't meet it, we can actually look at the fourth quarter for 2020 and compare that to the fourth quarter of 2019 and see if we qualify. If we do, then we get to use that quarter, or we get to use that test for that first quarter of 2021. So that's helpful. If we meet the test likewise for 2021, then we can use it for 2021 first quarter, and we get to use that for the second quarter of 2021. So a nice benefit there for that year for the retention credit. And then one thing to keep in mind, if we weren't in existence for 2019, you might wonder, well, then we can use that quarter for 2020. So if we're comparing first quarter 2021 to 2019, but we weren't in existence, then we would use the first quarter for 2020 as the comparison there. So some good news on 2021 for the ERC. So if we don't qualify based on the gross revenue, we're not out yet. We can look at suspension of operations, as you're probably aware, for 2020. If you had a lot of surgeries performed at your provider, at your at your location. Then we probably looked at, or you probably looked at whether you qualify based on suspension of operations through a government order for the elective procedures. The good news is that that suspension of operations applies to 2020 and for 2021. However, when you're looking at that suspension, you can only claim the credit during that period of time. So like Jim said earlier, probably mid-March to maybe April or May, depending on what state you're in. Now, if there was a certain city or a location that had a more restrictive suspension, we could look at that as well. So, but it is during that covered period. So that's something to keep in mind. And then we need to look at, what was the government order, what dates did they use, and what did they actually suspend? Given that healthcare is likely, an essential business. However, like Jim and I mentioned about the elective procedures, there were pieces within the healthcare entity that was suspended. So because of that, we would classify healthcare providers in that case as being partially suspended. And because of that, you would qualify for the ERC because it was a partial suspension. And as that next bullet point suggests, it was a more than a nominal part of your business. I mean, surgery centers was a very large portion of a provider's revenue and a large part of your workforce. So you would meet that more than nominal test then. So those are things we want to consider when we look at it. Now, sometimes you might look at it and go, maybe the suspension of operations is better, and it can be. Most likely it's the gross receipts side, but you could run into a situation where the suspension of operations might be better. And we would look at that and talk you through with that. Some other things to consider, the regs look at not partially suspended, specifically if you're able to telework like we are at Eide Bailey, we're teleworking. So we can work at home. Obviously, a lot of providers, we don't have that situation. Customers are required to stay at home due to a government order that does not constitute a partial suspension because it was your customers and it wasn't the business. When you look at the supply chain, you also want to look at, was the supply chain suspended due to a government order? Just because we're obviously running into a lot of supply chain issues, purchasing supplies and whatnot. So want to consider, was the supply chain actually suspended? Was the member of the supply chain suspended? And then on suspension of operations, one thing to look at is, I know, specifically with providers, we want to look at, do we have semi-private beds either in the hospital or the provider setting, and we needed to privatize those rooms because of COVID. So we can take a look at that with you and see if we meet that nominal test or nominal portion, because that might qualify us for the ERC because of that suspension of operations, changing the semi-private to private rooms as an example there. So if we qualify based on gross receipts or a suspension of operations through a government order, then we qualify and we would look at the qualified wages. So we look at qualified wages based on the Social Security wages of box 3 of your W-2. So we look at that, see if we have wages there over either the covered period of the government order suspension or the quarters that we qualify for based on gross receipts. We also get to add, the good news is we get to add the share of the employer's health plan expenses, and that includes dental and vision in addition to your traditional health plan expenses. So we'll look at that and add that in to determine that threshold of $10,000 that Jim opened with. One thing to consider though is, are we defined as a large employer? So for 2020, I think Jim alluded to this, that's companies with more than 100 full-time employees for 2020. The good news for 2021 is that threshold increases to 500 full-time employees. So if we're over those limits, then we can only claim the credit on salaries that are paid, but for salaries that were not attributed to service. So if we're paying employees and they weren't working, that's what could qualify based on qualified wages for a large employer. So much more advantageous to be defined as a small employer, then we can take all the qualified wages. So that's the good news on that. The large employer definition is based on 2019. So we would look at the average full-time employee count for that period to see if we qualify. And one thing again to keep in mind, like the gross receipts, we want to consider the aggregation rules. to see if we are a large employer based on our aggregate number of companies. So back on that clinic example, it'd be, the clinic plus the surgery center that we own, or if it's a hospital that owns a surgery center, it's a hospital plus the surgery center that we own and any other ancillary businesses that we happen to own. So yeah, health plan expenses we can include, which is helpful. Like I said, it's the cost that the employer pays, but also if we're pre-taxing contributions, a lot of providers, health, hospitals, nursing home, a lot of our providers have self-funded plans, or where the contributions are pre-taxed, or they have a cafeteria plan where those premiums are pre-taxed. Then we can include the employee portion in addition to the employer portion. So that's the good news there. The IRS did allow us some leeway there and allowed us to do a pro rata allocation of those premiums. So that's helpful. Sometimes we don't have the employer premiums by employee. So we can include an allocation there. It just needs to be reasonable. And there's 2 examples there based on covered employees and based on the periods of coverage, obviously. That would be helpful. The other thing we get to include is we probably had some furloughed employees. We get to include those healthcare costs as well for the furloughed employees. So we get to include that as qualified wages, which is helpful. So how you claim the credit, where does the dollars actually come from? So we report the total qualified wages and the health insurance costs, again, includes dental and vision, on the quarterly employment tax return in order to actually cement and claim that credit. So that's a 941 that you file quarterly. If we filed it already, there's good news. We can amend and file 941X and send that in as well and claim the credit. So that's good. So that's how we actually send it to the IRS and get the dollars back to you. And there is a 3-year statute on that. So, we're obviously past 2020, but we can obviously go into and amend those returns. And we are doing that for providers. A lot of providers still doing 2020 ERC credits. So don't think that you've missed the boat on that, because you haven't. So some good news there on that. And I believe with that, I will pass it back to you, Jim.
Well, thank you, Sean. And one more thing to note on this slide is the credit is fully refundable. So don't think that, gosh, I didn't have enough tax liability to use this credit, right? It doesn't matter. In most cases, like Sean said, we're amending these returns and the IRS will cut you a check for the amount of the credit. It's taken 3 to 6 months, but you'll get a check eventually, right? So, all right. Just going to hit a couple other highlights here. A couple things to note. Unlike PPP, there's no requirement to maintain a certain level of employment or certain level of payroll. If you have employees and you paid them, you can earn the credit on it, assuming you're an eligible employer. There's no dollar limit on the amount of credit claimed. In this industry, I have a couple of nursing homes that have quite a number of employees, and we're talking about millions of dollars of credit. So it could be huge. You do need to know that the credit is effectively taxable. So it is a reduction of your wage expense or your wage deduction on the tax return. So it's basically a reduction in the amount of the credit, right? If you had $100,000 credit, we reduce your wage expense or wage deduction by $100,000. And if you claim the credit for 2020, the guidance says that you have to amend your tax return to reduce that wage deduction on your 2020 tax return. So that's not the greatest answer. I thought they would allow us to carry forward, but they are sticking to their guns. And so you do have to amend that return. In terms of some limitations, just know that, if you have owner employers and there are owners who are also receiving wages and they're majority owners, right? Greater than 50%. We can't pull in their wages for the credit. We also can't include any of their family members for the credit. So, the IRS is just trying to exclude, I guess, family-run businesses, and it's mostly in other industries where they've hired a bunch of people that are family members and then try and claim the credit on it. All right. Want to talk briefly about PPP. So what we have here is initially when the CARES Act came out, you couldn't take PPP and ERC. They were mutually exclusive. But in December of 2020, the CAA basically came out and said, nope, we want to give taxpayers the opportunity to take advantage of both provisions, and they made it retroactive. Now, a lot of people had already filed for PPP forgiveness for 2020. So we're bound by whatever you filed on that application, right? If you said, hey, I want 8 weeks of payroll, and it's during a period you would qualify for ERC, we're going to have to back those wages out. We can't take the same wages for both provisions. That said, we have a ton of latitude, and basically what we can do is we can model around your PPP, especially in 2021. Let's say you got a PPP2 loan, it's going to straddle Q1 and Q2. We're outstanding at modeling around that to maximize your ERC for both periods or one period, to make sure you get full forgiveness, because that's the most important, but maximize your ERC around it. If you haven't filed for forgiveness yet, a couple of things I recommend. One, maximize those non-payroll costs. You can use up to 40%. Rent and other things, go ahead and get all those on there. Two, make sure you select a 24-week period. Again, we can move that money around inside the 24 weeks. All right. Couple of things here. So substantiation, there in notice 21-20, there's requirements you need to meet, or there's records you need to keep if you're ever audited, to make sure you can substantiate your ERC claim. Those are here. I know I'm running into Tyler's time here, so I won't spend a lot of time on it, but just know that you have to keep records to support your ERC. Last thing I will mention, so a couple of examples. I think I brought up nursing homes, right? Assisted living facilities. Gosh, they had a huge drop in revenue in Q4, Q1. Doors were locked. They weren't allowed to admit new patients in a lot of cases. So we're seeing some huge credits in that area. Suspension of operations, as Sean discussed earlier, really we have that late March timeframe through late April, early May, depending on the state or the jurisdiction you're in, where elective procedures were suspended. So again, that's another area that we have been able to claim the credit for operations. So in the healthcare industry. So it's certainly out there. There's, like I said, this is a 2-hour webinar if you really want to get into the weeds, but if you think you qualify or would like to discuss it with us, we do have an assessment form you can fill out at ibailey.com/ERC. And you can fill out that assessment form and we'll give you a call and walk through, hey, we think you qualify or you're not going to meet the eligibility, and kind of walk you through what that credit would look like. So please reach out with additional questions. And with that, I will hand it over to Tyler.
Excellent. Thank you, Jim. And actually, before I start here, we had a few questions that popped up. So do you and Sean mind answering as we walk through them quick, just to make sure we get them covered?
Absolutely.
All right. So the first one we got here, would you clarify the more than nominal test for medical practice that is under partial suspension, required to have social distancing, but did not have a decrease in gross receipts?
Great question. And so the more than nominal test is a 10% test. And we're looking specifically at what was limited by a government order. And it could be revenue or service hours. So take, for example, a dental practice. If you were under specific orders to do a deep cleaning, and normally you did 10 appointments a day, right? And after this, or after the COVID protocols, you can only do 7. That would qualify. So that's something we certainly look at.
All right, next one up. There's actually one in the questions, one in the chat. They kind of go together. I think you covered on it, but we'll throw it out there again just to readdress. Any idea on how long or when these ERC checks are actually going to be received?
So this is a great question. And what we found out in August is that the IRS stopped processing these returns in June through really September. Basically, they're sending out so many incorrect checks that they needed to train their people. They took the month of September to do that, and we are seeing checks again in October and November. They are not on a FIFO process. There's no rhyme or reason why this client's getting their check and that client isn't. I'm still saying, gosh, 3 to 6 months to get your check. I hope it starts speeding up as the IRS brings more people back, but it's slower than I would like.
I love how you can bring FIFO into an IRS discussion. It's perfect. All right, so next one here. If you decide to use the previous quarter, and that's in quotes, for a 20% revenue drop, for example, Q1 of 19 versus, or Q1 of 21 versus Q1 of 19, to establish the eligibility for Q2 of 21, are you then required to always use previous quarter? For example, Q2 of 21 versus Q2 of 19 to qualify for Q3?
No, you can use any method you want, just as long as you use the look back. You know, you can use the other method for the other quarters if you want, whichever one benefits you.
Well
Excellent.
said.
And then the last one here isn't necessarily a question as much as it is a comment. And I'm definitely not a tax person, so I'm not going to disagree. But if you have any comments in response to this, important to note, if an employer operated at a loss of an amount in excess of the credit, then the credit would effectively be tax-free.
Well, if you have a loss year, potentially, it depends on the organization, right? C Corp, S Corp. But you're reducing your carry forward loss. So potentially you don't owe additional tax, but you have a reduced loss carried forward.
Excellent. Well, thank you both. And they will both be sticking around to the end, so struggling through my part, I'm sure, but that's fine. So if you have questions that relate to ERC, feel free to pop them in there and we'll try to address them at the end, or as I go through, if you got questions, do the same. But thank you both, and we're going to kick off right into the PRF side. So as mentioned and consistent with what Jim said, I could spend hours on this, and if you followed along, I have spent hours on this. So we're going to hit some high points of what are the things you need to know. We do have a number of videos that are posted out on our YouTube channel, which is kind of crazy and cool that we have a YouTube channel, right? So YouTube, Eide Bailey, and you'll see not only PRF, there's employee retention credit, PPP, plenty of other stuff. And if you have specific questions, we have a dedicated email address to hopefully address questions as we can. And if not, provide assistance to clients. So that is PRF, like the Provider Relief Fund, at eidebailey.com. Now, that does require you to be able to spell Eide Bailey correctly. So luckily it's on the bottom corner of every slide, and you have that in place. So we're going to kick off here. As I said, things you should know. What has kind of popped up in the last, I don't know, few weeks, months, etc., that we think are important that we can tag on to this. So phase 4 in the ARP rural distributions. If you were not aware of these were the new funding mechanisms that came out, and there was a separate application that needed to be filed. Unfortunately, those due dates are past. However, I have heard through sources that HRSA or HHS expects there to be additional dollars available once all of these distributions are made, so they might go back and let it reopen. So if you missed the cutoff, just be aware of that. Kind of keep your ear open here. If you did go through the process, when you went through the application, you first had to validate the tax identification number, and then you had to enter all of your information in. What you would have noticed is there's a third box here. It is attesting to the payments you received. So hopefully, once these payments actually get processed and are received, you'll need to go back through and perform these attestations. Very similar to what you did previously if you received funds under phase 1, 2, 3, or any of the targeted pieces. But just kind of to note, there is one more step in the process of receiving the funds. If you don't attest after 90 days, it's kind of assumed that you will have attested. But I've recommended definitely go in and do the process. If you haven't, you'll notice that it might trigger a couple of things, like when you went in to do these phase 4 applications, the phase 3 probably might have still been sitting there and you needed to go through that process. As far as timing, because right now that is the biggest question I'm getting on this. I think we're sort of expecting, or I've been told that the ARP rural payments should be out in November. I know we're in November. They said before Thanksgiving time period. The phase 4 would probably be in the range of December rolling into 2022. So just be aware of that. As it relates to these attestations, I do want to point out a couple of things here. First, there are a couple of new provisions when you attest. Most of the terms and conditions are consistent with what you've previously seen, but you'll notice a couple things in here. One, if you have a merger or acquisition, you are required to report that to HRSA. There is this specific reporting piece. And two, if you have not fully earned all the funds once you receive them, you are now required to put them in an interest-bearing account. If you went through the phase 4 reporting, you probably had the question of how the heck do I calculate the interest? Because I don't know what I did with these. Now you have this requirement. So it does need to go in an interest-bearing account. I'm sure it'll be 0.001% or whatever the case may be, but still a requirement now. Also, on the ARP rural side, there is another requirement in here. The tax identification number that receives the funds is required to use the funds. There is no ability to transfer or allocate those funds. So be aware of that if you get these ARP rural funds. Completely different than any of the other funds previously, right? So how do you actually use them? This is a question brought up a lot because there's a lot of confusion. So for either of these, the period of availability starts at the beginning of the pandemic. So it is not at the date of your last receipt or the date you receive these. It can start at the beginning, and it will go through generally at least December 31st, 2022. So you will have over a year to be able to utilize these funds for allowable purposes. And hopefully, I know it's still fairly unclear, but I think we've gotten a better feel for how to use these funds, right? So to prevent, prepare for, respond to coronavirus or related losses, lost revenue as a result of coronavirus. And consistent with the past, you can't use this to reimburse expenses or losses that have been reimbursed or obligated to be reimbursed by another source. I keep going through these provisions till I'm blue in the face, but we'll keep doing them. And I think we're getting a better understanding of what this really looks like. So again, period of availability, take note of that. I think that's an important key. Now, if you utilized funds, let's say from March of 2020, for the first round of PRF or for PPP, et cetera, you can't still use the same dollars. So it doesn't mean you can quote unquote double dip, but it does mean if you had and incurred expenditures that weren't used by anyone else, you can claim them for this. And I do know one of the things for a lot of groups, as you work through this, there is a lot more losses occurring, after the June 30, 21 date. So the ability to be flexible over this next year, I think will be important. Want to also point out on the ARP rural side, there is a new frequently asked question. I am not going to read it for you because I'm sure you can all do that and you'll have the slides, right? So if you notice, however, one of the things that jumped out to us here was in that second paragraph, they brought back these terms, incurred expenses necessary to maintain healthcare delivery capacity, which kind of creates another broad open window. We'll talk in a few minutes about what we look at for eligible expenditures, and I think that's still an area we don't have all the answers to. Phase 3, so as I said, phase 4 and the ARP rural is closed for now. Maybe it opens back up. So as we sit today, there isn't really any new money on the table unless you got phase 3 and you looked at it and said, hey, I think they paid me incorrectly. And if that's the case, you can actually submit an application for reconsideration. So it is only if you feel that you have been paid incorrect. It can't be because you want to change in methodology or policy, etc. If you do have this situation, there is an online request form, and it must be submitted by November 12th. That is 2 days from now. So if you have not looked at this and feel like you've been paid wrong, definitely jump in. All right, let's go back in time and look at some of the historical payments. This is often a big question because when the Provider Relief Fund website was under the HHS address, there was actually a nice timeline, and it spelled out, hey, here's when certain funds were received so that you could line it up. Most funds, so all the general distributions, the targeted distributions for rural facilities, for safety net hospitals, et cetera, fall under kind of the same rules of, they're called other PRF. There is a specific distribution, however, called the infection control distributions. And those do have very specific terms and conditions that require a very specific expenditure. And the reason I point this out is when you get to the reporting, and none of these were received prior to June 30th of 21. So it's going to fall in this reporting period too. And I'll tell you what I mean in a second. They have a whole separate reporting that will need to be done. They'll need to be carved out. So the question then is, okay, what are these infection control distributions? So if you follow through, first off, you likely have a skilled nursing facility, a nursing home, or similar, because that is who's receiving this funding. If you received the first amount, generally in the May of 2020 time period, and you'll notice the calculations here. Again, we kind of would look at, what I look at is, when did you receive the funds, and can we recalculate what the amounts that we got were? So if you got funds in May of 2020, and it seems to fit this payment methodology, the 50,000 plus 2,500 per bed, you probably got the skilled nursing facility distribution. That falls under the other distributions. If you got funds in August and it falls under this same calculation methodology, that was the first infection control payment. So be aware of that, because that needs to be tracked separately, and you cannot use lost revenues for these distributions. Okay, so let me repeat that. You cannot use lost revenues for the infection control. Now, I've said this over and over, and I think it's getting through to many, but these quality incentive payments, and these were generally received in the October to early 2021 timeframe, based upon your activities from September to December of 20. And they were really based on infection rates and quality rates, right? Most people thought, hey, I earned these because we have these high quality rates. We kept infections low, we got money. Unfortunately, these also fall under the infection control distributions. So if you received any of those funds, you'll want to pool them all together and then specifically review those with the expenditures, and you cannot use lost revenues. Once again, what did you receive? How can you kind of look at it? There are a couple of databases, just to be sure, since the reporting window hasn't opened. And so I provided links here. Copy them down, take note. It will look like a CDC database that I'll show you in a minute. So the first one will basically be able to provide you all of the provider relief funds in total you've received to date. We use this when we're performing audits or other procedures to make sure that we have everything, right? The population's complete. I'd recommend you do the same. So do the check. You'll basically type in your organization's legal name and it should pop out with the amount. Unfortunately, it is cumulative, right? Payments to date. So it is everything. The quality incentive payments, there is actually a specific database for this. So if you aren't sure on those pieces, those quality payments I mentioned last, pull up this database and take a look through. Also, the Provider Relief Funds created an uninsured reimbursement program. Basically, if you did tests and procedures for COVID for uninsured individuals, you could bill them through this program and get paid at Medicare rates. Oftentimes, this was done by the billing or business office or whatever department that is not finance and accounting, right? So finance and accounting may not even be aware of this. It's important to understand it for a number of reasons, but one of them being compliance, because it is still a federal program. It is not Medicare. So there is a database, as I mentioned on the previous slide. Here's kind of what you'll see. All three of these links look the same way. So you'll have a data set, and you'll see in this upper right-hand corner, it says find in this data set. You can type your organization's name in, you can type the city, etc., and pull up what you actually received for any of these programs. So when I talk about single audit here in a second, this is important because you'll need to make sure you know all of what's going on, because again, this is a federal program. So you got funds, when do you actually report? This is where it became really confusing, right? So all of the reporting is entirely based on when you receive the funds. So take the date you received it. April 10th was that first date. Many of the dollars magically showed up. And I kind of talked through a number of distributions. So find the date that you receive the payment on this chart. You'll see the deadline to use the funds. Again, the covered period begins at the beginning of the pandemic. And then you'll see your reporting time period. You cannot report early, unfortunately, and if you miss the deadline, then kind of out of luck, with one exception, and I'll talk about in a second for period one. So take note of this, copy down this schedule if you don't have this. When we get to period where ARP or the phase 4, you'll notice that we'll be having reporting dating out to 2023. Right? So you're going to have to mark calendars so that it's not forgotten about and you got to pay money back. On the portal, when you actually log in, I point this out because it is important and helpful, especially if you fall into one of the later reporting periods. There is a number of resources, or there are a number of resources available at these various links. I point out the top 4 here, right? So the one I like the most, the portal worksheets, is an Excel schedule from HHS that mirrors the reporting. So I would fill that out, and then you'll have it available when your actual reporting window opens. So identifying those expenses and lost revenues. The other one to point out, if for some reason you feel like you've received amounts in excess of what you can actually support, and you'll have to return dollars, and that'll be happening here pretty soon, starting in December. You'll notice the bottom left, there is how to return unused funds. So take note of that. All right, grace period. As I said, the deadlines for all of the reporting periods are pretty strict. There was a 60-day grace period for this first reporting window. So while it was due September 30th, it is now going to be due November 30th. You'll be able to maintain compliance by then. If you have to report dollars back, or actually have to return them, sorry, if you reported that you will return funds, they'll be due by December 30th. So 30 days afterwards, and I showed you how to find the amounts that are going to be due. All right, one of the main questions I always get, and I know you're looking for this answer, and unfortunately I don't have it very specifically because every one of your unique scenarios is different. So when you look at this, here's a broad view of what is eligible as an expenditure. I think you need to be aware that amounts should be for preventing, preparing for, and responding to coronavirus. That is a very broad category. So the key, the onus, the burden of proof, as HHS says, is on the provider to maintain that documentation and rationale. And it will vary from one group to the next. So you may have heard that the clinic, hospital, dental practice down the street did this. That may be an opportunity for you. However, you have to look at it in light of your own circumstance. So everything should be viewed from that perspective of, is this to prevent, prepare for, and respond to coronavirus? One thing to note, however, HRSA put out this nice fact sheet on personnel costs. And it does seem to allow and create a broad variety of expenditures under these personnel categories, things like recruitment and retention. And I know many of you, doesn't matter what type of healthcare industry you are in, you are feeling the salary crunch, right? The retention crunch, the recruitment cost. So many of these costs regardless of whether you've incurred them in the past, kind of fall into this category. So use this as a prime opportunity. On the lost revenue side, just going to touch on this very briefly because there is a lot more that we've talked about previously. Again, you can tune into some of the previous podcast or previous webinars on our Eide Bailey channel on YouTube. So 3 options available. Option 1 is purely a comparison to the prior year, or meaning 2019, the base year. Option 2, you must have your budget approved prior to March 27th, 2020, and it must cover the entire period. That becomes very difficult for most. So we've seen many utilize this option 3. When utilizing the option 3, the one thing I want to point out, make sure that you have a decent amount into your narrative document. It should explain your calculation of lost revenue, why it's reasonable, and why that loss was attributable to COVID and not another source. So important categories there. Quick note here, because this is probably the second most common question that we get, because HHS was very confusing here. What do they mean when they're talking about revenues? Because they say things like it needs to exclude contractual adjustments and charity care and bad debt. So what they mean is net patient service revenue, and you can be able to walk through this FAQ here. Take your gross, reduce it by your adjustments, and you get to the amount in patient care related revenue. Hopefully that clears it up for most. Single audit applicability. If you received greater than $750,000 and you have to report on that into specific periods in your fiscal year, you may be subject to a single audit. And this is especially important to the commercial entities because you have not generally had to follow through with these types of reporting requirements. So take a note of that. And what falls under this? You'll notice here all the check marks. So the Provider Relief Fund is all of the various categories that in distributions that you received. There are also those uninsured and underinsured billings. That's why I pulled that up previously, even though that is not Provider Relief Fund. So you have to accumulate it all together during your fiscal year. If it exceeds $750,000, you may be subject to a single audit. Here's the chart that kind of walks through that. So for periods before June 30, 2021, there is no Provider Relief Fund single audit. If you had a single audit done, I apologize. You'll have to do it again. Unfortunately, what you did does not count and you received some bad advice. So June 30, 2021 fiscal year ends are the first period that you'll actually be under audit. And you'll see from there, it'll be entirely based on your year end and the reporting that you submit to HRSA on what you'll actually claim. A couple of notes on due dates, because that is the next biggest question. Okay, if we have to get a single audit, when's it due then? So for June 30, 2021 fiscal year ends, there is a 6-month extension. So generally, single audits are due 9 months after your fiscal year end. In this case, you'll see the deadline got extended to September 30th. What this means, however, if you are a September, your deadline is still June 30th. And if you are a December year end, your deadline is September 30th, 9 months after year end. So there's going to be a crunch of a ton of these types of single audits being performed across the country in the same tight window. Be aware of that. If you are subject to a single audit, here are the categories that are going to be relevant. So allowable costs and activities are what you think they are. Was the cost eligible and was it appropriately reduced by any reimbursement you received from outside? Reporting, there's specific key line items, and they're the things you would expect. Total expenses, total revenues, etc. It is not going to be testing things like the number of employees that you had during the year or your other assistance received, which is a nice thing. And then there's this special tests and provisions which deals with out-of-network, out-of-pocket billing. So if you treated COVID patients, this may be relevant. What I can tell you is there is still no direct answer on how auditors are going to be testing this. It's unfortunate. So I think this is going to push a lot more things out. So to conclude here, when it comes to dollars you received and reporting, what should you be doing? Document. We're talking generally of hundreds of thousands, if not millions of dollars, at least tens of thousands. I would generally expect a commensurate amount of workload into documenting and supporting the funds. So why is the expense that you are claiming eligible? Why does it prevent, prepare for, respond to coronavirus? And did you have a consideration of whether or not it was reimbursed by another source? On the lost revenue side, if you choose option 3, why is that reasonable? Why was it attributable to COVID? And internal controls, if you're subject to a single audit, this will involve testing of controls. So what is your control? Were activities reviewed, approved, or monitored? And this is probably different than other programs because it'll happen on the back end. It is not going to be a sign off on an invoice. It's likely going to be a review of the actual reporting. So document, and retain that documentation. The time frame for retention is 3 years after you're done reporting. So with that, I think we got a few questions. We'll see what we can hammer out here in the last couple of minutes. So Jim, as you're popping back on, do you see any overlap or challenges relative to taking advantage of both ERC and Provider Relief Fund?
So let me answer from the ERC side first. And the answer is there is some overlap in terms of, one, we need to count the provider relief funds as revenue. And I believe that's generally considered revenue when it's spent, is my understanding, right, Tyler? So that would be the quarter that would be captured. The question becomes, gosh, when you use PRF funds on wages, that gets a little bit trickier, right? And you probably shouldn't be double dipping. I think, I guess I try and avoid it and use it on lost revenue is, I guess, my answer on that, to avoid the double dipping. Tyler, on your side, what are you guys seeing?
Yeah, same thing. I think you need to be cautious and aware of it to know, for example, if you are claiming wages and payroll taxes, but you are in essence claiming and getting reimbursed for that, or effectively not paying it, right? Because it's reducing your tax payment. You really haven't incurred that cost then. So you probably shouldn't be claiming those payroll taxes. So I think that's really where it kind of comes into play. It really doesn't touch on the lost revenue calculation because it is not considered patient care related. So it falls into that other assistance received. Second question here, I believe lost revenue may be the most obvious place to allocate PRF utilization of funds, but after that, it seems some of the wages, compensation, benefits could be allocated to or reimbursement by PRF or ERC. I think we kind of just covered that, right? It's going to depend. I think the key is being very diligent in assigning those costs so that you know that you're putting them in the right bucket and you aren't double dipping. For phase 2 reporting for Provider Relief Fund, do we know if it's going to be similar to phase 1 or other guidance or questions? That is not out yet. I fully expect it to be very similar, except we're going to add 2 more quarters, right? Because that goes through June 30th. This phase 2 is going to go through December 31st. I have not seen anything on it. I am hoping that if you had to do phase 1, it will automatically roll over into phase 2 and kind of be easy. Nothing's easy though. So as of now, I'm under the assumption it'll remain consistent, but I have not seen anything. And then I know we're hitting the end, but we only got one more question, so let's knock it out. If all patients are considered COVID possible, are not all expenses to prevent, prepare for, and not just incremental expenses allowable? As I said, I think it is going to be very unique to each individual organization. You're probably potentially viewing it from the perspective of maybe a hospital, but from a dental practice, maybe that looks different. Or if you're a not-for-profit, because certain behavioral health and other groups receive dollars. So there isn't a clear answer to this. That's why ultimately you have to get back to, was the dollars or were the dollars to prevent, prepare for, or respond to, and can you make that connection? And then also, can you have that consideration that amounts weren't reimbursed by another source? So exactly the same questions that were asked on this tie with ERC. So I think those are the important considerations. All right, we're a couple minutes past, but maybe you can take us home, Jim.
All right. Well, thank you, Tyler. Appreciate your time today. And Sean, you too. Great presentation. Hopefully, everyone got something out of this. If you have questions, our contact information is on the screen now. And of course, you can download a PDF of the slides as well. So thank you for your time today and have a great afternoon.